TheoTrade. This is Don Kaufman, November 20th, 2021, doing the TheoTrade weekend update on a Saturday morning. Well, our discussion, once again, is going to be about tech dominance. But the real question is, does tech dominance create systematic market risk? We're going to explain that and much more here on this weekend's update. Let's get to work with, once again, similar statement to, well, the last couple of weeks. The markets are just owned right now by Tesla and NVDA. Now, over the last couple of weeks, I've actually displayed precisely that of the impact of literally two underlyings. And I'm actually going to kick it off with, again, some just incredible market internals from yesterday's trading session, just to further display, right, the absolute dominance of a handful of underlyings. And again, you know, the concern obviously here is if these underlyings are to unwind, what the impact would be to the broader marketplace. So with that, I kick it off here on this Saturday morning, taking a look at the QQQ. So the Qs are just parabolic at this point. You know, looking at this at like a 9-month daily, I just don't think it even does it. You can look at like a 3-week, okay? But when you start really opening up, even to like a 10-year, okay, the acceleration in this most recent move to the upside is nothing less than astounding. The other aspect, and just, I guess, pointing that out on like the visual on the chart, it doesn't do it for me as a quantitative trader. So for me, and we're going to talk a bit more about this, I have tendency to look at what is termed the expected move. And these are just weekly moves that are denoted by the options marketplace. Okay, to get even more specific, you know, if the option marketplace, okay, in the QQQ says we're supposed to move up or down, let's say $10 in a given week, that's what's displayed over here. There's no directional bias whatsoever. And these auto expected moves, okay, are being derived, right, from the option chain. So it goes out about a week in time. And for example, we would cruise over to this November 26th here, and it's about a $7 expected move. So that's kind of what you see here in the chart. And if you take a quick glance, again, I'm a very quantitative individual. Nevertheless, I like to paint this on the chart because I think it paints a very nice picture for you. But you take a look. This one tagged the upper edge of the expected move, tagged the upper edge of the expected move, exceeds it, exceeds it. Okay, we break to the downside, exceeds it. But the point of me going through here is just the number of times when you look at this and you're like, well, what does that really mean? So what? We broke through the edge of the expected move. To put this in context, okay, because we're going to talk quite a bit about, you know, some of the quantitative side of this, but to put it in context, if you look at this as a standard distribution curve, all this expected move is like a standard distribution curve turned on its side. So we're supposed to stay, you know, inside this range, you know, 68% of the time. The reality is we keep tagging one edge, keep tagging the other edge, closing outside. And when you start to see it, you know, sequentially, we break through, we mellow it out, we break through. Okay, I mean, statistically speaking, it gets pretty insane. And we're actually going to look specifically at that. So, all right, markets, as I said, are kind of owned by Tesla and NVIDIA. And for this, okay, I want to take you into some of the price action, if you will, that happened specifically on Friday. First and foremost, the financials. This trading week, the financials, they're getting whacked back, all right, in a big way. And this is probably due to the fact that the administration is going to be maybe announcing a new Fed chairperson. So Jerome Powell, my belief anyway, is he's out. He's out of the contest. And they're probably going to bring in, you know, Brainerd. We'll see. And that announcement should have come out anytime throughout the course of this week. Nevertheless, the financials are not reacting well. It's like the financials already know something. But the point of me, why am I bringing you into the financials early on? I thought this was supposed to be about tech and its domination. It is. Take a look at the financials, breaking below the edge of the expected move. Then I want you to take a look at the energy sector. The energy sector, very similar move to the financials, gets whacked back. Now, the energy sector gets whacked back because there's news over in Europe that COVID, once again, is taking a little bit of a toll albeit minimal. There are some lockdowns that are occurring throughout portions of Europe. And there's, the possibility, again, of a little bit of a economic slowdown due to COVID. Nevertheless, energy gets whacked back, the financials get whacked back, and they're outside the expected move. I mean, you just have to look at energy being off 3.9%. The Dow, not often that I actually talk about the Dow. The Dow actually tagged the lower edge of the expected move on the week. Like, what else do you want, people? It tags the lower edge of the expected move. And yet, the S&Ps, the S&Ps are massively unchanged. And effectively what I'm saying, I'll look at the spiders in this case. The S&Ps were actually ending up on the week. And, well, what's even crazier about that is even when you start looking at, like, Google. Now, Google had an okay week, right? But Google finished the week unchanged. But Google was down 0.6%, Amazon was actually down, and Amazon had an astounding move to the upside on Thursday, but Amazon was actually down on, of course, Friday. Nothing that I'm pointing out here, whether it's financials, whether it's energy, whether it's the Dow off, even Amazon and Google being down, could not, drag down the S&Ps. It couldn't drag down the S&Ps. And again, the S&Ps finished the day down, a whopping 3 points. I mean, for the most part, massively unchanged, which, again, it leads and points to the direction, of course, of Tesla and NVIDIA. And everybody, Facebook played a role over here. Yeah, but Facebook, it has played a role maybe in the short duration, kind of like Amazon played a role on Thursday. Maybe Facebook played a little bit of a role in the rally on Friday. But again, we're seeing some rotations within the sector. What about Apple? Apple had an astounding week to the upside over here, but it's not like the pivotal underlying. In fact, when you start taking a look at Apple, Apple did come on strong at the end of the week. In fact, take a look at the number of options that actually traded here in Apple, and it is nothing less than shocking. By the way, we did over 50 million contracts in the options marketplace on Friday, but this was normal volume. When it says sizzle index of 1, that means that's normal versus the previous 5 days of trading. Nevertheless, if you take a look, Apple, some serious size trading in here. Taking a look, of course, at Tesla, which is having another rip-roaring day. Tesla, have a little respect for the fact that it did trade almost 2 million contracts, which was like half its normal size. 2 million contracts, but it's on a $1,100 product. Looking at Apple and you're like, Apple's a big boy. Apple traded, 3 million plus contracts. Yeah, well, Tesla's a $1,000 stock doing almost 2 million contracts. Of course, then you bring into scope NVIDIA. The reason I'm actually showing you the option volume, people, this is what's driving markets right now. The bottom line is like you're thinking like, oh, it's they're buying this, right? There are retail clients that are going out there and buying calls like they're going out of style in NVIDIA. A lot of the market-making proprietary trading firms are hopping on board, watching retail rush into the marketplace. The option volume is unequivocally the option volume driving the entire marketplace. Again, when you're seeing over 50 million options that are trading in a given day, those are just incredible numbers. Again, I left the brokerage side of the business after 15 years at both Thinkorswim and TD Ameritrade. I left the brokerage side of the business in 2015, and I can tell you, from 2015 till right now, so I'm 6 years out of the business, and back in 2015, I remember we were talking about like it would be amazing to do 30 million contracts a day. Amazing to do 30 million contracts. Here we are a few years later doing 50 million in a given day. It's incredible. And literally the option marketplace is without question, again, it moves the stock, and that's something I've explained time and again. So this has absolutely changed the nature of what you should be looking at in the marketplace. And there's a lot of people that they don't like that. They don't like change in the marketplace. So I am going to throw out some comments over here that you may not like, but market internals. When I talk about market internals, people look at a lot of market internals throughout the course of a given day. I mean, I, for one, I actually use what I call Quantix. It's a tick. And what the tick actually does over here when I start pulling up Quantix, and it's not exactly all inspiring to look at, of course, on a weekend here, but I'm going to look at ticks. This is like a accumulation of ticks, and it's comparative Quantix. But if you take a look, these ticks were absolutely hideously down, especially in the Russell and the Nasdaq. The ticks were hideously down throughout the course of the trading session. If you wanted to take a look, and when I also market internals, so that could be fair to actually bring up like S&P 100 advanced decline line. Look, the advanced decline line, it's not so good. The ticks straight down over here. People, doesn't make a difference. Internals, aren't going to matter anymore, right? Overnight S&P trade doesn't matter. So the S&Ps, on Thursday night, for example, we're up over 20 handles. It doesn't make a difference because it's the order flow that rushes in right at the opening bell. Ding, 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 opening bell. Order flow rushes in. And that is what's actually dictating the markets. It's dictating the entire order flow. You've literally seen Tesla grip hold of the marketplace, NVIDIA grip hold of the marketplace, rotations. Like this week, we saw rotations into Apple. Okay, and you're like, well, what was going on? Why did they rotate into Apple? Okay, because again, we're playing like, rotate out of Tesla, rotate into Apple, other tech stocks in here. So it's a game of like a little bit of like whack-a-mole. Head pops up. Okay, one goes down, another one pops up over here, but it's all about tech right now. So massive rotations, okay, could take place if tech starts to sell off big. And we're actually going to have that discussion here momentarily. But again, I want to reiterate the point that right now in this marketplace, not only are Tesla and NVIDIA dominant, okay, when they're not, we're actually seeing rotations within the sector itself. Okay, they're so dominant that the volatility, okay, we didn't see any sell side activity this week, did we? Right? And yet you look at this and you say, well, the volatility, though, is up. If you look at the VIX is actually up. In fact, a lot of the volatility indicators are up. And that has everything to do with the fact, though, okay, that the market is actually pricing this in. All right. So we're starting to price in the fact that, you want to see a quick glance here at Tesla and its volatility. Okay. It's not nearly as heated as it was. By the way, what you're looking at right now is a volatility ranking. It's not necessarily pure volatility. But the volatility itself inside of Tesla is closer to 70%. It is actually literally rubbing off, if you will, into the S&Ps. So it's something to keep in mind. Also, if you look at the QQQ, okay, so here's the Nasdaq volatility, right? Just look out like 6 days or so forth. It's about 15.8%. Compare that to the spiders. Okay, where are the spiders right now? 10%. So what do we have? We have the Nasdaq actually pricing in considerably more volatility. And that's exactly why I posed the question. Does this tech dominance create systematic market risk? And the answer is absolutely unequivocally. In fact, I just showed you exactly why. I mean, when you have one or two underlyings, okay, that are moving at such a rate and they have such magnitude behind them, like $1 trillion company, which again, I've talked out, to pretty much nauseum. But when you have that kind of magnitude such that it's actually changing the volatility of given index, you got yourself some problems. And in effect, what this basically means is, and as I was saying, I was going to get into this here momentarily, but if you have Tesla starting to eventually see an unwind, okay, the effects of that could be not only dramatic to the entire marketplace, and I'm not just referencing the QQQ, but also the S&Ps, but where you would have to be careful, okay, is my assumption is it's not even like if, it's when we start to see a little bit of unwind of a Tesla or of a NVIDIA, okay, the rotations are going to be flying into other sectors. And that is one of the reasons I also brought to your attention, a little bit earlier, hey, look, all right, financials got whacked back. Okay, this could be on the very, near term, like forefront. Maybe you see a little bit more sell side activity in the financials. Okay, but does this mean to run in and short these financials? Probably not at this point in time, simply because you have to be terrified of the fact that when Tesla does start to get whacked back, right, you're going to see rotations into products like these financials, like, for instance, the energy sector. Places that right now are not receiving any love because, quite frankly, there's just not a lot of places to put capital right now. Again, it is profound, the moves that this marketplace is having. I'll go back over to the QQQ for just a moment. Again, if you take a look at auto expected moves, again, the number of breaches, okay, but it's also being found, if you will, right now inside of the Russell. The Russell should also be paid attention to. Now, we're completely, changing gears here from having looked at, some of the profound impacts of Tesla, NVIDIA and some of the other tech dominance in the marketplace. And I've actually come over to small caps. This has kind of fallen off everybody's radar screen a little bit. But after an incredible run inside, for instance, the expected moves, the IWM is actually extraordinarily heated up. We have a massive breach to the upside this week, actually another breach to the downside. Pay very careful attention. Again, this is where I believe that we could start to see some just wicked rotations. However, in the very near term, I think you could still see some sell-side activity in the IWM. I think you could see some hostile sell-side activity inside of the financials. Why? Because the change of the guard possibly at the Fed. Nevertheless, okay, that tech dominance starts to subside, and they're going to come rushing back towards a few of these sectors. Again, specifically the financials, possibly the energy sector. Regardless of what you may think about energy, it's not going to make a difference. There's not a lot of places to put capital at this point. But after profound market moves, you're going to see very profound, rotations, okay, if tech starts to sell off. All right, one other aspect over here. Markets are bidding risk assets. The Fed, I would probably put this under the category of Fed. Basically, what I'm saying is if you would take a look at this and I say they're bidding risk assets, right? Take a look at, for instance, the bonds. The bonds actually have a pretty good bid under them. What is interesting is the bonds were bid, the last 3 days of the week, right along with, for instance, the volatility, the exact same 3 days. You can take a look at like the VVIX, okay? The volatility index also went bid throughout the course of this week. Take a look, for instance, at dollar, okay? The dollar is absolutely exploding to the upside and continues to actually break out. Meanwhile, all right, this is an area that a lot of people are not necessarily paying attention to right now. Now, of course, you could point to the fact that, well, maybe the market sees the fact that, this tech dominance is not necessarily a healthy thing, and it's not a healthy thing. Again, when you've got systematic market risk, that basically means, one of the dominoes starts to fall like a Tesla, and the rest of the marketplace is going to effectively move with it. The thing that is not clear at this point, and it's an unknown over here. Why are we actually bidding up into skew? Why are we actually buying dollar? Why are we buying bonds? I mean, and skew, just, with all due respect, skew is back up there. I mean, skew is highly elevated here, back up to like the 148 handle, which is it the absolute highs? Absolutely not. But there's a huge amount of hedging activity. You see the volatility coming up. You see the dollar coming up. Bonds are rallying over here. As I said, I think it could be partly this tech dominance, but net, you have to be a little concerned. What I've actually done, okay, my own concern over here is I don't care at this point whether you're bullish, whether you're bearish. I'm tightening up my delta. Doesn't matter whether you're long, whether you're short. You got to tighten up a little delta over here, because one of the things I've come to the rationalization of timing what is going to be eventually, a market unwind is going to be a little bit of futility. I mean, right now, come on, we don't even have market internals. The S&Ps overnight don't seem to matter. Everything is about order flow that's just, on the horizon. The bell goes off, order flow comes piling in, redefines the marketplace every single morning. So that's not something I'm comfortable taking a huge amount of directional risk. I absolutely am still taking directional risk, but I've definitely tightened up my my delta. Meanwhile, with high skew, okay, this is as good as it gets for premium selling. And that's what I'm doing. I mean, what else can you do in a marketplace that I'm a little bit uneasy, if you will, about the what this is going to look like, a couple of days or even a few weeks out, especially with risk assets being bid up. So, I mean, a lot of people look at this, they go, what do you mean, man? I'm just outright long. I mean, long scares me to death. It really does. Like, going long this marketplace. I think if you're going to be bullish at this point, you got to use defined risk spreads, right? You're going to be bearish. Okay, use defined risk spreads. Premium selling, though, has been spectacular, and I'm actually selling premium out there way out of the money and doing it naked in the major index products simply because, I mean, you don't have to look too far to actually see. Look, I'll give you a 90 days out and switch over to implied volatility. Take a look at some of these far out of the money options. I mean, we're 36, 39, 40 volatility. You're getting paid at a 40 vol, people. You're getting paid at a 40 vol when the VIX is down at, the 17, 18 level. Nevertheless, okay, there's still some risk out there. You got to learn how to mitigate some of that exposure. Last but definitely not least, we come to the SPX. The irony is the SPX, it's gotten docile. It's docile, if you will, like the last 2 weeks of trade. And that's exactly why I'm telling you right now, there's all these major sectors that are defecting, but nothing matters but a handful of underlyings. Okay, you have risk assets bidding up. Again, I am uneasy, hence why I'm tightening up my delta over here. The next thing is coming into a holiday week of trade. It's Thanksgiving, so the market's going to be open Monday, Tuesday, Wednesday. U.S. markets are effectively closed on Thursday, and yet a half a trading session on Friday. But at the exact same time, the expected move is still 54.75, basically $55. So the S&Ps are pricing in, and I found this kind of interesting, plus or minus basically $55 move, all right, up 55 or down 55. And yet we only have 3.5 trading days. Well, the previous week, we had a full 5 trading days and there was $60 expected move. So this is actually some fairly big boy risk. Again, the implication there, yeah, it's quite simple. Tech, people are listening now. People's eyes are open. They see this going on. There's a wicked bifurcation in the marketplace. Okay, it can only last so long. You have, again, defection of many, many major sectors out here. Okay, pay careful attention. Just because we're coming into a holiday week of trade, nobody cares, people. Everybody's sitting at home, working from home anyway. What are we going to do this week when family is in town? We are going to trade. Before I go, I want to let you know that it's Thanksgiving. Inflation is upon us and prices are sky high, but not here at TheoTrade. Normally, it's $1,200 a year to be a member here at TheoTrade, but we want to be the only thing in life that's less expensive for you this year. So if you take advantage of our Black Friday offer, you can lock up an entire year of TheoTrade for just $799. This way, you can save a whopping $377 over the course of the next year. But this special Black Friday offer is only available until Cyber Monday at midnight Pacific Standard Time. So if you want to save $377, this is the only time you can do it. Just click the link below this video right now, and we look forward to serving you over the course of the coming year. Thanks, everybody, and have a wonderful weekend. Bye-bye.